Hello and welcome to our discussion on financial accounting. In this session we will see the process of converting a set of business decisions into accounting equation and financial statements, namely the balance sheet, income statement and cash flow statement. For this we'll take a set of transactions. First we'll convert them into accounting equation and then we will convert them into the financial statements. So this accounting equation is of the company A Limited. So we'll take one by one the transactions and try to convert them into the accounting equation. Started business with cash, so it has come as a capital, a source, and the amount is 50,000 and the corresponding cash is 50,000. They availed loan of 10% on 1st October. So the cash increases by 100,000 and no change in the capital, but a new source comes into picture which is called loan and the amount is 100,000. Purchase stock of goods for cash, unless specifically mentioned, will take the transaction as cash transaction. So the amount of the value of the goods purchased is 30,000. So acquisition of stock resulted in the outflow or reduction of cash. No change in the capital, no change in the loan. Once again, we purchase shares of 85,000 for cash is another asset acquired. The value of the asset is 85,000. No change in stock, but cash reduces by 85,000 and no change in capital and no change in loan. Sold 60% of the stock. So we have stock of 30,000, sold 60% of the stock for 50,000. So cash increases by 50,000 and stock decreases by 60%. So therefore we have stock of 40% of 30,000. No change in the shares, no change in the capital, no change in loan, but a new source comes into picture called profit, and for the time being we treat the profit to be retained, so profit stays in the company, and this profit is determined as sales, which is 50,000, minus cost, which is 18,000. Paid commission. So commission is an expense and outflow of cash. No change in stock, no change in shares, no change in capital, no change in loan, but the profit reduces to the extent of the commission that we paid. Rent due but not paid. The rent due but not paid has to be recorded because of accrual concept. The accrual concept says the transaction should be recorded at the time of happening of the event. So though we have not paid anything for the loan, for the rent, but rent will have an effect on the profit. Okay, so the amount of rent is no change in cash, cash remains same, no change in stock, no change in shares, no change in capital, no change in the loan, but the profit comes down to the extent of 4,000. Profit comes down to the extent of 4,000. A liability is created. Liability is created, and that liability is called rent payable. An expense not paid is a liability. Acquired C Limited, a startup company, by issuing shares. So we acquired C, and that is an asset for us, and because we are expecting cash flows or economic benefit in future. No change in other shares, no change in stock, and no change in cash because we are paying the acquisition by issue of shares. So cash, no change, but the capital increases to the extent of investment made. No change in the loan remains same. No change in profit because it has not affected any incomes or expenses, and no change in the rent payable. Purchase plant on credit from Z Limited is another asset acquired. The value of the plant is 52,000, but we will create a liability called plant supplier to the extent of 52,000. No change in rent payable, no change in profit, no change in loan, no change in capital, no change in cash, no change in stock, and no change in shares, and also no change in C, value of the asset. And in this period we receive dividend. So dividend is an income and cash flow. So the dividend will increase the cash and will increase the profit because dividend is an income. But there is no change in any other item on the equation. So no change in the rent payable and no change in loans or capital, loan and capital, no change in the other assets too, like stock or shares or C or the plant. So we have done all the transactions, but you observe that there is a commitment to pay interest of 10% because of accrual and matching principle. We have to show this, and the rate of interest is 10%, but the loan has been taken on 1st October, and we are assuming that the accounting period is a year, and from April to March, so interest is due and payable for 6 months in this case. And let us assume that we pay the interest. So the cash reduces to the extent of 5,000, and profit reduces to the extent of 5,000, and no change in any other items. So all other items like loan, capital, stock, shares, and other assets all remain same. So in the process of converting the decisions into the accounting equation, we saw that the profit at the end of the year is 23,000, the cash is 80,500. If we want to summarize this accounting equation, we can prepare a summary accounting equation. The summary accounting equation will look like this. It says that assets of the company is 329,000. Supported by equity of the company, which is capital and profit, and supported by the liabilities, and in this case the liabilities are loan, rent payable, and the plant supplier. But we can see this, that the company is financing its assets 53% by equity and 47% by liability. So this process of converting business decisions into accounting equation very clearly shows the application of accrual principle, the application of matching principle, and the application of accounting period, which are the fundamental concepts of accounting. So the accounting equation shows at any point of time the assets are supported by equity and liabilities, and equity is the profit, the retained profit, and the capital contributed by the shareholders, where the liability is the obligation of the firm to pay and to the outsiders. Thank you very much.